This is the story of how European football, once built on community, passion, and identity, became one of the most attractive assets for global finance. A story where billion-dollar funds replace lifelong fans in the boardroom, where decisions are driven less by trophies and more by returns, and where the beautiful game quietly transformed into one of the most sophisticated investment vehicles in the world. And at the center of it all, private equity giants like CVC Capital Partners, Blackstone, and KKR, firms that saw something in football long before most fans realized what was happening. To understand this invasion, you have to go back to what football used to be. Clubs across Europe were not just businesses, they were institutions tied to their cities. From the industrial roots of clubs in England to the deeply political and cultural identities in Spain and Italy, football was never just about money, it was about belonging. But as television rights exploded in value and global audiences grew into the billions, something shifted. Football wasn't just culture anymore, it was content, and content in the eyes of Wall Street is monetizable. The first wave of change came with billionaire owners. Roman Abramovich at Chelsea FC, Sheikh Mansour at Manchester City. These were transformative figures. They injected cash, elevated competition, and changed expectations, but they were still individuals, emotional investors, prestige seekers. Private equity, however, plays a completely different game. It doesn't fall in love with clubs, it evaluates them, restructures them, and exits them, ideally with massive profit. When firms like CVC Capital Partners began targeting European leagues, it wasn't random. They saw underdeveloped commercial potential. Take Italy's Serie A. Once the most glamorous league in the world, it had fallen behind in global revenue compared to the Premier League. For private equity, this wasn't decline, it was opportunity. Buy in at a lower valuation, restructure media rights, centralize revenue streams, and unlock hidden value. This is exactly what happened when investment groups proposed billion-euro deals for stakes in league media rights. Not ownership of clubs, but ownership of the future cash flows. That's the key difference. Private equity doesn't need to own the badge. It just needs to control the revenue engine behind it. Spain followed a similar path. When CVC Capital Partners struck a deal with La Liga, it marked a turning point. Billions were injected into the league in exchange for a percentage of future broadcasting income. For struggling clubs, this was a lifeline. For investors, it was a long-term annuity backed by one of the most popular sports on earth. But critics argued it was something else entirely, a mortgage on the future of Spanish football. And then there's France. The collapse of a major TV deal left Ligue 1 in financial chaos. Enter private equity. Once again, firms stepped in with capital, restructuring media operations and stabilizing the league. But stability comes at a cost. Control shifts, decision-making changes, and slowly the priorities of football begin to align more with quarterly returns than long-term sporting integrity. But the real revolution isn't just happening at the league level, it's happening inside clubs themselves. Private equity firms are now taking direct stakes in teams across Europe. They're buying minority shares, restructuring operations, and preparing for eventual exits, often through resale or public listings. Look at Italy again. Clubs like AC Milan have experienced ownership changes involving investment firms. These aren't local businessmen or lifelong fans. These are financial engineers. Their job isn't to win titles, it's to increase valuation, and sometimes those goals align, but sometimes they don't. Because here's the uncomfortable truth: success on the pitch is no longer the only metric that matters. In many cases, it's not even the primary one. What matters is brand growth, global reach, and commercial scalability. Can the club expand into Asia? Can it build a digital fan base? Can it monetize content beyond match days? These are the questions being asked in boardrooms now, and in some ways, private equity has made football more efficient. Clubs are run with greater financial discipline, wasteful spending is scrutinized, revenue streams are diversified, but efficiency isn't always what fans want. Fans want passion, they want loyalty, they want a sense that their club belongs to them, not to a fund based thousands of miles away. This tension reached a boiling point during the European Super League proposal. While not directly a private equity project, the logic behind it was deeply aligned with financial thinking. Maximize revenue, minimize risk, guarantee participation. It was football redesigned as a closed investment product. And the backlash was immediate and fierce. Fans protested, governments intervened, the project collapsed within days. But here's the thing, the idea didn't die, it simply evolved, because the forces driving it, global capital, media rights inflation, and investor expectations are still very much alive. Private equity doesn't need a super league to profit, it just needs control over the structures that generate money, and increasingly that's exactly what it's getting. So what does this mean for the future of European football? In one sense, it means more money, more investment in infrastructure, better stadiums, improved broadcasting quality, expanded global reach. These are real benefits. But in another sense, it means something more subtle and potentially more dangerous. It means the gradual shift of football from a sport into a financial asset class. When clubs are valued like tech companies and leagues are structured like investment portfolios, the game itself begins to change. Decisions are made differently, risks are calculated differently, and the emotional core of football, the unpredictable, chaotic, deeply human element, starts to clash with the cold logic of finance. Because private equity has a timeline. Typically, these firms aim to exit investments within 5 to 10 years. That creates pressure. Pressure to grow revenue quickly, pressure to increase valuations, pressure to deliver returns, and that pressure inevitably trickles down to players, to managers, and ultimately to the pitch. You start to see it in scheduling, more matches. Is more tournaments, more global tours. The calendar becomes saturated, not because it's good for the sport, but because it's good for business. You see it in ticket pricing. As clubs chase higher revenues, affordability becomes less of a priority. Local fans, once the heart of the game, risk being priced out in favor of wealthier global audiences. And perhaps most importantly, you see it in identity. Clubs that once stood for something specific, working class pride, regional identity, political expression, begin to feel more like global brands, interchangeable, marketable, optimized. This doesn't mean the soul of football is gone, not yet, but it does mean it's under pressure like never before. Because for private equity, football isn't sacred, it's strategic. And that raises a question every fan should be asking. What happens when the pursuit of profit conflicts with the spirit of the game? The answer isn't simple. In many cases, the two can coexist. Smart investment can strengthen clubs and leagues, but without safeguards, without governance, regulation, and fan involvement, the balance can easily tip. That's why some countries are pushing back. Germany's 50+1 rule, for example, limits investor control and ensures that members retain majority voting rights. It's not perfect, but it represents a different philosophy, one where football remains at its core a community asset. The rest of Europe is watching closely because the private equity invasion isn't slowing down. If anything, it's accelerating. New funds are entering the space, new deals are being negotiated, and the financialization of football is becoming more sophisticated with each passing year. So the next time you watch a match, whether it's a Champions League clash or a domestic derby, remember that there's another game being played behind the scenes. A game of valuations, media rights, and investment strategies. A game where the stakes aren't just trophies, but billions of dollars. And in that game, the winners aren't always the ones lifting the cup. Because in the age of private equity, football isn't just about who wins on the pitch. It's about who owns the game itself.